Good afternoon, everyone. Welcome to this webinar, which is organized by our Institute of Certified Public Accountants of Uganda. My name is Owen Amanya, and I'll be the moderator for today's webinar. I'll be hosting as panelists CPA Sumesh Joseph De Cruz, a partner with PKF East Africa, and Mr. David Lado, an audit senior with PKF East Africa as well. They'll be taking us through the IFRS updates for the year 2020, specifically touching on what's going to change for us and what we should look out for in our businesses. It's now 3 minutes past 2. We shall shortly start the webinar. Just a few housekeeping guidelines for anyone that has questions. In the interest of time, so that we can start and finish on time, we request that you put your questions through the Q&A and not the chat. If you look at your screen, just before the share screen where the green arrow is on the left, you should see Q&A. Please post your questions there. We'll pick them up and we'll make sure that they are answered. If you do have questions to direct any of the presenters, please do indicate it in your question, and we will do that. We'll direct it to that person. Without any further mentions, I'll request Mr. Sumesh to come on, and we can start the webinar. We'll start with Mr. Sumesh, then we'll have another presentation from Mr. David Lado, and the questions will be attended to after the 1 hour of their presentations. Please pay attention and enjoy the new lessons that we are picking from our facilitators. Thank you. Mr. Sumesh, most welcome.
Thank you, CPA Owen, for that introduction. A warm welcome to all you participants on this cloudy afternoon. Thank you to CPA Uganda for allowing us from PKF to present to you. I am here with my colleague Davis Lado. We have broken the presentation into 2 parts. The first part, we are going to talk to you about the impact COVID has had on our financial reporting. Yes, a lot has changed. It's uncertain times. There are a lot of things changing. And this is actually the first time that we have seen standards being revised or dates being delayed by the board at IFRS at such at such short notice. Yeah. So I'm sure the slides are going to be shared with all the participants. We have put links to the IFRS websites and other resources that we have used for your more detailed study or at your own leisure. And my colleague Davis is going to take you through the updates on IFRS for 2020. Okay, so that's what the webinar coverage is going to cover. I am going to do the new and revised development in IFRS and the impact specifically due to COVID. Now, remember guys, our impact due to COVID is in 2 main areas. Yes, one is on your valuation and measurement, and 2 is on presentation and disclosure. So let's start. I'm sure that all of you are aware that there's been a huge disruption on due to the COVID-19 pandemic that has been ongoing. It has significantly impacted a lot of organizations in Uganda, in other countries. Many of you might know or might have personally been affected by the repercussions that COVID has had on our economy and on our businesses and at your workplaces. Yeah. So in the next few slides, I'm going to try to cover the financial reporting challenges and the implications that COVID-19 has had on IFRS. What are the main areas that COVID has impacted? Yeah, we have going concern, we have events after the reporting date, we have fair value measurements, the ECL for financial assets, lease accounting, hedge accounting, deferred tax government support, and revenue recognition. In summary, these are the areas, if you are preparing financial statements, auditing financial statements, reading financial statements, these are the things that you are going to want to look at and have more information about. So let me very quickly take you through this. Going concern. IS 1, presentation of financial statements. What is going concern? Going concern requires management to assess the company's ability to continue as a going concern. With COVID-19, things are not so sure. Why are they not so sure? Because many businesses are under a great amount of stress. In Uganda, for example, many businesses have not been in operations for more than 2 months. So they are under strict they are actually distressed, meaning they have cash flow challenges. They have not had revenue over the past few months, yet they have liabilities and obligations to meet. Yeah. So if you're a preparer, your auditor is going to ask you, how did you assess going concern? Yes. So usually we assess going concern for a period of 12 months, but in reality now we might actually need to extend that period of assessment for going concern. Events after the reporting period. As auditors, as users of financial statements, many of you are actually finalizing on accounts that have that are due by 30th of June, and they are being signed off. Yes, but we need to carefully consider the disclosures that we need to put in to reflect the actual adjusting and non-adjusting events that existed due to COVID-19. So that's under ISA 10. Yeah. So when you see anything underlined in blue, it's a hyperlink. It takes you to a resource or a document if you have the time and you want to do further reading. Yeah. Fair value measurement and impairment of financial assets. This is now another big area. Yes. A change in fair value measurements, of course, it affects the requirement by IFRS 13, which require companies to disclose the valuation techniques and the inputs that they have had to use to come up with the fair value measurements, what we call FVM. Now, a key question over here is the condition and the corresponding assumptions were known or knowledgeable to marketing participants at the reporting date. Because remember, this has changed. Pre-COVID, you had one set of assumptions that you are using to measure fair value. But post-COVID, you've had to change all this assumptions that you're using. Yes. So IFRS 13 is another area that is actually being impacted. So for example, for 2020 fair value measurements, particularly of financial statements and investment property, will need to be reviewed to ensure that the values reflect the condition at the balance sheet date. This will involve measurements based on unobservable inputs reflected on how market participants would consider the effect of COVID-19. Now, there's one thing I wanted to make clear. It's actually an area of a lot of uncertainty. It is an area where we don't have much resources we can't forecast what is going to happen in the future. And because of that, it is an area that changes really on a daily basis. So what you might use as assumptions today might not necessarily be the assumptions that you're going to be using tomorrow. So please, if you're using it, if you're preparers of financial statements, users of financial statements, please, you have to pay attention to the changes that COVID-19 is wrecking on all our lives currently. Yeah. Then impairment of non-financial assets. That's IAS 36. That's also impacted. Yes. IAS 36 actually ensures that your company's assets are carried at not more than their recoverable amount. Yes. And requires the companies to conduct impairment test. Yes. But now imagine what COVID-19 has done to a lot of these financial assets. You may have property, plant, and equipment. For example, you may be a hotel that has not been operated for the past 2 months. So really, is your property valued at the carrying amount that you are currently having? You might have intangible assets, might be goodwill in a business that is under distress or can no longer function. So you have to consider the impairment of use. You might have right of use assets, investment properties. So COVID has actually thrown a curveball to a lot of us when it comes to assessing impairment of non-financial assets. So companies will need to assess what COVID has potentially led. And in my case, more likely than not, it is going to lead to an impairment in non-financial assets without doubt. So what does that mean? For a company, it means you're taking down most of your asset basis. Yes. Yeah. If you're an auditor, you are actually doing more tests around the areas where we need to look at those assets. Yeah. For example, valuation of inventories is subject to IAS 2. This now requires measurement of lower of their cost or NRV. But our NRV calculation will more likely than not require a more detailed method of assumption. And many companies may actually need to write down their stocks. Why? Because we don't have the sales. Yes. So there's no revenue. That means you're seeing the stock getting impaired, especially if it has short shelf lives or you have stocks that are close to expiry periods. Expected credit loss for financial assets. I think this is an area where CPA Owen is well versed with, being in the banking sector. Indeed, even Bank of Uganda has come up with guidelines, and IASB has also been quite proactive and published guidelines on how we are supposed to treat IFRS 9, especially with the view of expected credit losses and the credit risks that are going to be faced by banks and other lenders. Why? IFRS 9, in a nutshell, it lays a lot of emphasis on one main area, and this one main area is building historical data to support your future projections. But COVID-19 has kind of put a disclaimer on the entire historical data that you have, that it may not actually be reliable because you are in what is that cliche that they use? It is a new, it's a new way of doing business. It's a new dawn. Yes. So you have a lot of businesses that are stressed, that may not actually be able to come up and repay their this thing. So IFRS 9 has a huge impact on this. Lease accounting. I'm sure many of the participants over here have worked for companies that have either asked for or have for a rent reduction, or have have been in a place where they are actually the landlord and are going to give the tenants a rent reduction. So leases are also affected by COVID-19. Yeah. So again, our IASB has issued amendments to IFRS 16 to make it easier for the leases to account for the COVID-19 rent-related concessions. Yes. The changes provide, one of the main listing is it provides leases with an exemption from assessing whether COVID-19 related rent concession is a lease modification. Yes. So, and then it requires leases to apply that exemption to account for COVID-19 related rent concessions if they were not lease modification. And one of the things that I keep telling you is that IASB has really moved fast, and you have to give them credit for it, because this amendment is effective 1st of June 2020. Yes. But with the caveat that lessees can only apply this amendment immediately in any financial statements, interim or annual, not yet authorized for issue, which means it has not yet been signed. Yeah. So effective date, remember, comes with a few caveats, so please consult before incorporating it. Deferred tax government support are another areas that is another area that has been impacted by COVID. Income taxes, although I know in Uganda we have very limited concessions in terms of taxes and all of that. We are hoping for more. Let's keep our fingers crossed. Yes, but in other countries, tax rates have been reduced. Tax holidays have been given. Yes. So what does this impact? It impacts your deferred tax, or and the uncertainties surrounding the estimation of deferred tax. Another thing that has been impacted is revenue recognition. Well, you all know the 5 steps. I'm really not going to dwell on the 5 steps that you need to take to recognize the revenue. But where has COVID-19 impacted revenue recognition? It could affect the assumptions that are being made by the management in measuring the revenue for goods and services that have already been delivered. Yes, for variable consideration and anticipate the outcome of the contract. Yeah. So, for example, reduced demand could lead to an increase in expected returns, or additional price concessions, or reduced volume discounts. So all of this needs to be factored in when we are preparing the financial statements. Now, again, the FSSB has voted to extend for 1 year the effective date of revenue recognition standard to all private companies and private not-for-profit entities. So if you're a private company, you have an extension here, yes, from 2020 to December 15, 2021. So again, good news, yes, but a few caveats over here. So please consult before you you jump into any changes with the standard. Yeah. Now, the next few slides technically are going to take us through. We have 3 columns. You have the revenue, the consideration for the preparer, and you have the potential audit implication. We have already talked about IFRS 15 being impacted. Yes, we have talked about how reduced demand could lead to an increase in expected returns. Yes, and how is it impacting the preparer? It is impacting the preparer in the sense that variable consideration can only be recognized when it is highly probable that amounts recognized will not be reversed. So what revenue recognition is saying is that we need to be very careful in in recognizing revenue during the COVID-19 period or situation. Then we have, again, 104 might not actually be very very Uganda specific because we don't have too many privately defined benefit scheme and share-based payments going. But if there is, you need to be a bit careful. But 204, an entity may reduce its workforce as a result of COVID-19. IS 19 requires a liability for employment termination to be recognized only when the entity can no longer withdraw or offer those benefits, or the costs related restructurings are recognized in accordance with IAS 37. So that is an implication that might potentially impact us. Audit implication is really your auditors need to pay more attention around the provisioning that is taking place. Now, 3 or 4. Entity should also consider whether they have a legal or constructive obligation to its employees in connection with COVID-19, which is sick pay or payment. So again, we have to recognize the liability for auditors. If there are any auditors over here, again, you need to be very careful on how you're auditing around the area of this provision payment. The word, I'm not going to dwell too much on it, but if you're canceling, again, there is a bit of work that needs to be done around it. Still on valuation and measurement, what about your assets? Cash, cash balance is safe. Are they with reputable and strong financial institutions? Yes. Okay. So that is a consideration for the preparer. As an auditor, you as well as a preparer, you have to assess the creditworthiness of the banks and assess whether the banks are strong enough to ensure that your deposits and cash balances are safe. Trade receivables. How does trade receivables get impacted? Yes, determining and measuring the increased level of provisions, because like it or not, a lot of debtors are not going to be able to pay us, correct? You guys might already be seeing that it's more difficult to collect debts. We are in a cash crunch position. Yes, so what does that mean? We have to have a higher level of provisions. Yes, so you have to be very careful about the provision. As an auditor, you have to make sure that your work around doubtful debt and provisionings are done with your thinking cap on. Yeah. Inventory. What is the impact of COVID-19 on inventory? Obsolescence. Yes. Obsolescence, because you might be holding time sensitive, or you might be dealing in time sensitive stock, which because of COVID-19 and non-trading can no longer be sold. So again, higher provisions, which means your P&L takes a hit, which in turn impacts the performance of your company. Yes, do prepayments still have value? Yes, it's not a simple recalculation exercise. You might have prepaid your rent, but you might that puts you in a very weak position to negotiate for a downward reduction of your rent, because your landlord will happily smile and tell you, look guys, why don't we talk about this next year? Yeah. So those are some of the considerations that you have to think about. Government assistance, really not very applicable in the Ugandan scenario. There are a few government assistance that, like yesterday, I believe, for private schools, NSSF was suspended. So that is actually a 10% cost saving for the institution. And that now needs to be factored into your financial statements as well. Yeah. Other claims, tax assets can also be impacted. Yes. Intangible assets and goodwill, I spoke about this earlier. Yeah, it's a very rare situation, but if you come across it, please feel free to reach out and consult. We'll be happy to guide you through it. Property, plant and equipment, how is COVID impacting our PPE? Judgment, yes, because IAS 16 requires depreciation to continue to be charged to the income statement, even though your asset has been idle and may still be idle. Yeah, so that is how it impacts. IAS 23 requires capitalization of interest to be suspended when a development of an asset is suspended. So you have a catch-22 situation over here. If you are developing, say, a big hotel or an arcade or a shopping mall, you have to suspend the interest, but still on your other assets, depreciation is being charged. Yeah, so you have to be careful. Yeah, so. And remember, banks have also given a lot of moratoriums in terms of charging of the interest and all of that. That also has to be factored in and computed carefully when we are dealing with PPE. Investment properties, external valuation may be difficult to obtain. That's true. Because under lockdown situation, the valuer may not be able to physically access your premises to carry out the valuation, correct? So you might not be able to get it, or you might just be too afraid to go out there and get it. Yeah, investment in subsidiary, there's a higher risk of indicators of impairment because of the impairments that are going to impact subsidiaries and also investments in joint ventures and associate undertaking. So these are areas that really you need to pay very careful and keen accounting consideration to. Deferred tax asset, it's an area of judgment. You have to be very careful on the judgment that we are using. Talked about this in detail in the summary. Our ECLs and IFRS 9, we have also talked about, yes. We have to remeasure loss allowances, yeah. And there is a high likelihood of increase in credit risk leading to adjustments that are going to be required for the ECLs, yeah. Hedging, I think we don't have too many hedge transactions in Uganda, so I'm really not going to take too much time covering that. Okay, provisions we have spoken about. Yes, provisions, it's a large area. It's going to impact all of us. You really need to be careful with the provisions, whether it be a debtor provision or provision for expenses that you're bringing into your books. It needs to be well thought of, and it needs to take into a consideration all these issues. And you might also be looking at restructuring provisions if it may be required. Provision for onerous contract, yes, this is actually more of a legal thing. There are some contracts that you may not be able to meet because you cannot meet it because the cost of meeting the obligations are not economically viable. So you will have to use maybe a clause like force majeure to come out of things like onerous contracts, but on your profit and loss. So again, an area that that COVID has really impacted. Yes, debt obligation, accruals, tax liabilities. Again, all things are impacted by COVID. Yes, debt obligation. probability, you might give 90 days. Instead of 90 days, it might go up to 120 days, or you might have a payment plan. Yeah. So you really need to assess all of this very carefully. Yes. Embedded derivatives, again, not very Uganda specific. Yes. And reserves. Yes. Distributable dividends, for example, payment of dividends might be a fantasy in the current financial year, because most companies would have wiped out their reserves or might not have sufficient reserves to declare or pay dividends. So again, that's an area you have to be careful of. So that brings me to the end of valuation and measurement. Then this is presentation and disclosure. That technically this impacts more of the auditors out there. So I will take you very quickly through it. Yeah. So we have already seen. You have seen the number of slides that I've covered, and you have seen how COVID-19 has actually impacted almost every area that you're going to prepare your financial statements on. Yes, and that is just from an accounting point of view. I'm not here talking about economics or other things. Yeah. So what about disclosure? What is disclosure? Disclosure is the information we put out there to make the users of the financial statements comfortable, so that when they read, they can understand what information that we are presenting. So again, COVID-19 is going to impact this quite substantially. There'll be a lot of specific disclosures that will be required. And of course, it is an added effort to the auditors out there to come up with these disclosures. IAS 1, the impact of COVID-19 may cause management to make significant judgment in the process of preparing financial statements. So such judgments, we have to disclose it thoroughly. Yes. And as audited thoroughly. Sources of estimation uncertainty, again IAS 1. Yes. COVID-19 impacts certain balances, which we have already talked about. It may be difficult to measure precisely, because really we are living in uncertain times. Yes. And every day brings us new information and new ways and new methodologies of treating items. So what might hold true today might not be the case tomorrow. So again, we need to disclose how we are measuring these provisions. Yes. Going concern, IAS 1, we have again talked about it. Going concern it's a big talking point. Yes. And as more businesses are under distress and they are under stress, you have to ensure that your financial statements, both as preparers, users, and auditors of these financial statements, that you have covered your going concern assertion very, very thoroughly. Yeah. Okay. Capital IAS 1. Again, COVID-19 may cause significant changes to an entity's strategy in managing their working capital. Now, this has to be disclosed under full IFRS. Okay. Other general disclosure requirements of IAS 1 provides guidance on material items of income and expenses, which may require separate disclosures. The impact of COVID-19 may cause material unusual adjustments, which may require individual presentation. Yes, so an important point to note over there. But something I really want to point out over here: an entity shall still not present any item of income and expenditure as an extraordinary item. Okay, so you don't go and put an extraordinary item in your P&L reading COVID-19 health and safety or COVID-19 donation to community. It's not going to be allowed. Okay. Events after the reporting period. Again, we've talked about the presentation, the valuation and measurement of this. This is all about the disclosure. What do you need to disclose? We need to classify between an adjusting and non-adjusting event. Yes, and we have to find out whether it already existed at the balance sheet day, or it indicates a condition that arose after the balance sheet date. And once you do this, you need to consider the disclosure implication for both adjusting and non-adjusting events, and of course, disclose it in the financial statements. Yeah. So this is just like, for example, if an entity receives information about the reporting period, about conditions that existed at the end of the reporting period, you need to update the disclosure before you sign as an auditor, yes, in light of the new information. So for each material category of non-adjusting events, what is an entity supposed to disclose? The nature of the event and an estimate of the financial effect, the best estimate, yes, or a statement that such an estimate cannot be made, yes. But again, if an estimate cannot be made, please, we need to consider the implication for the ability to make an assessment on going concern. Revenue from contracts, again, a very tricky area that is going to be impacted by COVID-19. Remember, we have got an extension up to 15th of December 2021 on this for private companies. Yes, not for publicly quoted entities. I'm sure you know the difference in definition for both of those items. Okay. Impairment is another area that we've talked about extensively. So what the disclosure requirements of IS 36 are already extensive. Yes, so there is, but you should actually specifically consider the requirements to disclose assumptions and sensitivities for testing things like goodwill or indefinite life assets, inventories, or making additional provisions for your debtors. All of we should really think about putting adequate disclosures on all of that, and why it is specifically impacting your financial statements because of COVID. Government grants is not something that we get too much of here, so I'm really not going to dwell too much of it. Financial instruments, yes, that is definitely already the IFRS 7 has quite a bit of disclosures on it, but remember, we also need a lot of impact on forward-looking information, which has to be incorporated to your expected credit loss, the ECL. What does this mean? Like I told you before, a lot of this forward-looking information was based on historical data. But now we have a lot of uncertainty that we are dealing with, looking ahead. So it might not be a very easy thing to get into. Yes, so be careful around this area in particular. And also, when we are moving between the different stages, we need to be a bit careful. Financial instruments, fair value disclosures, again, what has COVID done? It's increased the volatility of prices in various markets. So therefore, you're actually seeing a seesaw effect on most markets. Sometimes markets are crashing because of some news or the other, and the next day markets are rising. How does this impact you? If you're closing your year end on the day that markets crash, that the markets crash, what does that mean? The value of the assets that you're carrying are going to be severely curtailed by those prices, the fair value prices that you're going to value them. But on the other hand, if you're valuing the assets where the markets were on a high, which could be as short as the next day, the value of the fair value of your assets are going to be tremendously high. So which one are you going to trust? Are you going to trust the depressed prices or the extraordinarily inflated prices? Yes, so it's food for thought. So this is an area that we need to be really careful about. Financial risk, credit liquidity, market risk are all disclosures that we need to look into, yes, and that are going to come into play. And we have to disclose both quantitative and qualitative aspects of this. Qualitative disclosures for each type of risks, so an entity should disclose the exposure of the risk and how it arises, objectives and policies, and any other changes or from the previous period. Quantitative disclosures, what are they? Credit rate, for credit risk, various disclosure requirements on the CR, including the ECL loss, and on market risk, the sensitivity analysis that arises from market risk. Yeah. Oh, really, the headache over here, guys, are on your auditors. So feel sorry for them at this time. Yeah. Default and breaches is another area that you need to look at, because a lot of entities are already struggling to meet payments due on loans or pay their debtors or other obligations. Yeah. So you have to make sure that if they are in default, adequate disclosures have been provided for in your financial statements, and any restructuring agreement that you may have come to with your bank should also be disclosed. Okay. Provisions and contingent liability, again, a lot of impact on IAS 37 because COVID will cause circumstances and uncertainties leading to increased provisions. Yeah. Again, of course, it not only impacts contingent liabilities, it also impacts contingent assets. So make sure that you're focused on both areas. Taxations, we have talked about how taxation is going to be impacted, although not too much in the Uganda context, unless there's further stimulus or economic package that the government releases in collaboration with URA, then we will have a direct impact on our tax position. Employee benefits, again, costs of redundancies, restructuring, the disclosures around that need to come out very clearly when we are dealing with post-COVID financial statements. Disclosures outside the financial statements, look, this includes the directors' reports. Yeah, requirements will vary. As of now, what we are doing as PKF is we are putting a COVID-related paragraph in our directors' report till we are in a position to where we have more clarity on how businesses are actually going to be impacted. Okay. Balance sheet, look, guys, you're going to have a very, very high likelihood of ending up in a net current liability position. Without saying, this is going to impact your going concern. So we need to think about and make sure that we have adequate disclosures around this area. Interim statements, of course, are also impacted by the same items. Yeah. So let me close this by telling you guys that your financial statement should tell the story. Yes. So what's the story? Your financial statement should provide information that is useful to the stakeholders and the key shareholders of the company. It should provide information on the estimates and assumptions that you have used in response to COVID-19, on how the directors are managing the risk, how your company is managing the risks, how your going concern is going to be impacted on it, and on the relevant information that you have obtained on the subsequent event periods. Yes. So the story should be based on the latest information available. Yeah. Up-to-date approval of financial statements. Yes. So if you have a case where your financial statements went out for director's signature 2 or 3 months back and are only coming back now as an auditor, then you need to look at updating those disclosures before you sign off on them. Yes. Audit consideration, I think as auditors out there, you have my sympathy, because there's quite a bit of work that you need to do around COVID-19. Your risk has increased, the level of work and assurance that we need to do around financial statements, and indeed the balances and transactions have also increased. Yes, so you need to ensure you consider material uncertainty, limitation of scope, and emphasis of matter. That brings me to the end of my slide. Thank you for being patient. I am now going to hand over to my colleague Davis Lado. He is going to quickly take you through the 2020 updates of IFRS. Thank you.
Thank you very much, Sumesh. Thank you everyone for keeping with us. Very enriching presentation there. I think we're seeing appreciations coming through, so well done. To the members that we are with today, we do have a Q&A session, but we do request that you please type your questions on the Q&A just in the interest of time, so that when the second presenter is done, we can then respond to the various questions. Some of them that are directed at ICPAU, I'll do pick them out and share with them. But for the questions that need specific responses, we'll be responding to them at the end of the session. With that, I'll invite Mr. David to give us his presentation. We'll try and keep it under 30 minutes so that we can give adequate time for responding to clarifications from the members. Thank you.
Good afternoon. I'm David Slado, and sorry.
Try again, Davis. I think there was just an echo, so try again.
Good afternoon to all of us. I'm David Slado, and I'm going to be taking us through the updates and the likely amendments that we have had in the year.
Davis, just a minute. Could you be logging in with two machines?
And,
is it a possibility?
I hope
Davis?
by the close of this, we shall be up to date with the current updates. Just a quick brief. There have been like 4 updates in there. That's to do with IFRS 3. That's the definition of business. We shall have another in IS1, which is entailing the definition of materiality and the need for classification of current and non-current, both for liabilities and assets. Then we also have a change, though it has been deferred, in IFRS 17, which deals with insurance companies. Okay. Then including the completed projects, the current completed projects, we have a detailed understanding on the IFRS 1, which is implementation and adoption of IFRSs. We also have changes in IFRS 9, which is the most, actually I think it is the most known standard now for all accountants. IFRS 16, leases, and IS 41. So to go in detail, I will start with IFRS 3, which is amending the definition of business. As shared on my slide, we had an old definition which stated a business to consist of inputs and processes applied to it in order to create output. But what are these in detail? Inputs could be assets, intellectual property, employees. All these are assets that you can put together with the aim of getting output, okay? But for it to be business, just like before, it needed to be put in a process. What have you put the assets to? What have you put your intellectual property to? What have you put the employees to? So the processes could be management processes, operating systems, production, maybe for manufacturing companies, or maybe resource management for HR, given the employees. What would be the likely output? Likely output would include earning dividends, low costs, economic benefits, like many companies are getting profits at the end of the year. So that would consist business originally. But now, is it necessary? The question would have, is it necessary for these integrated assets or activities to create output? What happens if I'm not getting output? There are companies we have seen that their key aim is not to get a return, but they are reducing, let's say, work to be done more effectively, or to reduce cost of production, that they see as being a business. Okay, so What is important is being capable of producing an output. It should not be like if you don't have an output, you don't see this is being a business, or rather, I would rather call it a group of assets, identifiable assets. Yeah. So IFRS 3 comes up with a concentration test that we are going to see later on in the later slides on how to identify either it being a business, or whether have we acquired a business, or have we just bought assets. Okay. This concentration test is ideally optional. It does not make, it's not a must to do it on either to when you're assessing whether a business is a business or just an identified asset group. So it is optional, though we can, for learning purposes or for application purposes, we can get to learn it. Yeah. So the principle here is if substantially all the fair value of the gross assets acquired is concentrated in one identifiable asset or a group of similar identified assets, then you do not have a business. Ideally, there you have just acquired assets. Let's say you've purchased rentals. You purchased 10 rentals, 10 rental plots, land and building in there. That would comprise a set of assets, identifiable assets, because there is no clear way on how you can devise that. If we should note the following, let's say tangible assets coupled together with an intangible asset, that will not comprise an identifiable or group of assets. There we shall have a business. If we have tangible assets of different classes, let's say we have inventories, motor vehicles, trade receivables, if you're acquiring such, then those are not identifiable assets. Those will comprise a business. If you are acquiring intangible assets of different classes, let's say brand names, licenses, and whatnot, still then you will not have identified assets. Those will be comprising a business. So what happens with this concentration test? Any asset group that would be recognized and measured as identifiable assets, or any tangible asset that is attached to another that can't be moved without materially affecting the cost or the impact having an impact on the value of that single identifiable asset, will not constitute a business. It shall be grouped as a single group of assets or identifiable asset. So that will take me to the current definition, what we have amended the definition of business to be with the new amendment. This clarifies that a business is considered if it has an integrated group of activities or set of activities and assets, which could include a minimum, an input, a substantive process, and put together can contribute to the ability to create output. Keywords there are input, substantive process, and being able to contribute to the ability to create output. If you look at the earlier slide, we're looking at an input being put together with activities in the company to create output. But the current amendment, the current definition is going to help us understand that necessarily a business doesn't have to necessarily create an output. It could be able, the keyword is contribute. Yeah, as I'm going to define the keywords later on, or just right now, they should be able or in position to contribute to create output. So what is an input? This is any economic resource that creates or has the ability to create outputs when one or more processes are applied to it. Let's say if I had IFRS 16 has come in this year, and let's say a manufacturing company acquires or has a lease on a processing plant, how should they recognize it as, is it an input to them? Yes, the answer is yes, because they are going to use it for this year, for this specific year. They have a right to it, and they can generate output from it after putting it together with other activities. What would we call this substantive process? What are the activities that would make it to substantive, to be defined as substantive? These are it's a resource that creates or has the ability to create outputs when one or more processes are applied to it. A substantive process is one that is significant to the production of output. Ideally, a substantive process should be unique, should be scarce, and without, it should, in case it was supposed to be replaced, it cannot be replaced without a significant impact on continuing production. Let's say if you're supposed to break the chain on, let's say, production cycle, if you were to change that particular activity, would it cause, it should be ideally in position to create an impact. If it can be done with or done without, if the production can continue without it, that means it doesn't break the definition of a substantive process. Then an output, these are results and inputs that you shall get from the inputs and processes that have been put together in form of things like dividends, low costs, benefits directly to investors or owners of the company. So here is a tree chart, or a chart on how we can get to the definition of a business. As earlier stated, the question would be, have you acquired assets and liabilities to meet a business, or are they just merely assets that you've acquired or liabilities? The first test is you can apply the concentration test, as I've already detailed it, but you should note that this is optional. Then the second step would be business in itself. Does it comprise inputs, substantive processes, and will they be able to contribute to the ability to create outputs? If the answer is yes, as you can see on your screens, we are going to be having a business. If it is not, then it is something, it is a critical process. If it is not, and is the process critical to the ability to develop or convert the inputs into outputs, they will have, if at all the answer is still no, we shall have acquired assets, not a business. When you look at is the process critical when applied to inputs? When is it continuing? Can we have it without disruption if our thought has been changed? Is there a need for skilled labor? Is there a need for knowledgeable persons or experienced people to work on it? If the answer is then yes, we shall have acquired a business. That coupled with the test that comes after that will identify it as an acquired business. So if it's not, then what happens? You ask yourself, does the process significantly contribute to the ability to continue producing the output? If the answer is no, you have not acquired a business, you just acquired assets. And when you look at the steps that you have undergone to get to the conclusion of whether you have acquired a business or not, they go back to our definition of a business. First, there should be inputs. Two, there should be substantive processes or a process. Then they should have the ability to contribute to the entity's ability to create outputs. In case the acquired group of assets doesn't meet either of those, then we shall have acquired assets. And if it is, as earlier detailed, we would have acquired a business. Okay, so what is different? As I earlier detailed, we have inputs. These will constitute things like non-current assets. As we all know, mostly it is going to be buildings, PPE, motor vehicles, all those items or inputs that contribute to the creation. The key inputs that you need in order to contribute to your outputs. Employees, licenses, things like KFC. If you have a patent or license to trade under KFC, not anyone can produce as KFC. you have a license to it. So that's an input for you. You're going to use that trade name, that brand name, to generate output. What process are you going to put to it? Here you're looking at systems allowing for the production of outputs. You might have the assets fine or the inputs, but you need a process. You need an activity to put to it in order to generate output. Yeah, like Kev says earlier said, someone has a license to operate under that brand name, but there are processes on how to deliver the output, how to avail the chicken or something like that, yeah? Then output, we are looking at things like goods provided to customers and services. We are looking at being able to generate investment income, let's say we're dealing in rental income. And also at the end of the day, any ordinary shareholder would be looking to generate a profit, okay? So what is this transition? The amendments must be applied to transactions that are either business combinations or asset acquisitions. In other words, before you rank them either a business combination or an asset acquisition, whatever you've acquired has to go through that three-step module on how to identify whether it being an asset or just a business as acquired. This will be in effect for all transactions relating to that for the reporting period beginning 1st January, and consequently entities that do not have, if after that you don't have to revisit transactions that occurred in prior periods. Ideally, this is a prospective treatment. What is the impact of this? Since the amendments apply prospectively, as I've already said, this is going to apply for periods that are after the date or that are occurring after the first application. Most entities will likely not be affected by this because ideally, if you had acquired your assets or businesses earlier before today or before 1st January 2020, you don't have to apply this. The ones that are being acquired currently in this year, or if in the periods after 1st January, you'll have to go through that three-step module on how to identify either a business or an acquired group of assets. That will take me to the next topic, as I earlier detailed. Also in IS1, there were amendments to IS1 and 8 on a definition of what is material in the books. Ideally, when we are presenting accounts or when we are using accounts for the different purposes, we always look to see what could impact our decision. So the ISB amended the definition of a material, of what is of material, what could be material for annual periods beginning 1st January, and early application, which would have been last year, could have been applied. So I'm going to take us through what is the current definition or the new definition. The current definition, I'll mean the old one, and what has been currently used as the definition for material. Then we're also going to look at the new definition, which has been rolled out by the ISB. Now, previously, we looked at materiality as omissions or misstatements of items being material if they could individually or collectively influence the economic decisions of the users on the users make on the financial statements. Now, previously we are looking at the size, materiality depended on the size and the nature, because they were either collectively or individually influencing the economic decisions. But as we shall see later on, the definition is going to change to accommodate the key aspects or the key users in the financial statements. The new definition states information is only material if omitting or misstating or obscuring it could reasonably be expected to influence the decisions of the primary users for the general purpose financial statements. Now, if you look at the earlier one, I'll take us back. We're looking at it as material being, information being material, if collectively, if it could, or individually or collectively influence the economic decision of all the users. But now we are being point specific. We are looking at the size, and we are no longer looking at the size of the misstatement. We're no longer looking at the nature, but we are looking at the specific users. Who are the primary users? We are going to look at this later on. We are looking at what could it influence the decisions. Previously, it was about it being able to influence the decisions. But now it is looking at, is it expected? Is there an expectancy for it to influence the decisions? This is just it's a difference in the English, but has a lot of detail to it. Now let me just maybe throw more light to that on the following slides. Materiality here now depends on the nature or magnitude of the information, or both. An entity assesses whether the information, either individually or combination of the information, is material in the context, or even if you took it as a whole. The new aspects that need to be noted are obscuring information. Then you also have to know the key or the primary users of the information. You also have to consider the possibility or the expectation that it could influence the users. Now, who are the users? Who are the primary users of this information? What could seem to them as potentially being an influential decision-making information? Now, previously, the standard had didn't point out some of these examples to point out what could be material, or if at all, it only stated about things like misstating and omitting. But currently, even obscuring information, it has the same effect as not presenting it properly. If, for example, my name is Davis, and if you call me David, it could potentially change or have an impact on the users of the financial, in case I was a financial statement. Now, presenting information in a vague or unclear way, it is material in its own stand. Material information has to be discrete. It has to be on point. That shouldn't be, I shouldn't need to have questions in able to understand that particular information. The information in the financial statements also, or about specific transactions, shouldn't be scattered. In case, let's say I'm looking at inventories, I should be able to understand what happened in the inventories or what they relate to in the specific set of financial statements in one note. I should not have to read 10 pages to understand what happened in a specific account head. Yeah. Also, the fact that most persons, or previously, it gave room, people would present events of dissimilar activities, where we would aggregate transactions. Let's say I have, I'm conducting a distribution business. I have revenue, but again, I'm incurring distribution costs. Should I include them? Should I reduce them from my revenue? So you're getting expenses and coupling them up with revenue. If someone was to use those financial statements, they would not be clear on what transactions or items actually traversed in the year. Also, the understandability of the financial statements has reduced as a result of material information being hidden by immaterial information. Sometimes you notice that accounts have a lot of information that is not actually material, and they are underneath the material information is being hidden. You cannot actually take out what would be processed as material because most of it has been decorated as immaterial, has been decorated by immaterial information. Now, the standard also goes ahead and redefines the primary users of the financial information. Previously, it was all possible users, but now, who who makes an influential decision on a company? Is it the public? I don't think it is. It would be the investors. We are looking at the lenders, the creditors. Most of the time, you'll see that banks need they need the financial statements in order to assess whether you're creditworthy or not. Some the big companies, let's say in case you're going to a big business where you're going to have to need credit to be supplied on credit, those suppliers or those companies will require a 3 or 2 year set of financial statements to see how you've been performing. Now, in assessing whether the information could reasonably be expected to influence the primary users, an entity must consider the characteristics of the primary users and the entity's own circumstances. What could be material to company A may not be material to the company B because they have different users, and also the entities themselves are different. An example would be, let's say, companies that are dealing in firearms. They might have bullets, let's say, that are worth 1 million, yet their turnover could be in billions. Yeah, when you look at that information, it is quite immaterial to the comparing the revenues and whatever misstatement could be there on the bullet. Let's say it's 1 million only. But what is the entity? What is the entity circumstance? What is the impact of these entities? This particular entity's misstatement. What would happen if at all the bullets are given to the public? So there is a material circumstance. You have to consider the entity's own circumstance in presenting what should be considered material or not. Yeah, this I've explained. What is the impact? The amendment clarifies the definition of material to make IFRS more consistent, but are not expected to have significant impact on the preparation of financial statements. It is ideally redefining what should be expected in the financial statement. Still in IS1, there was an amendment or an update on the need to classify information as either current or non-current. Most of the time you'll find that on most balance sheets, you find a jumbled story of what comprises the assets and the liabilities. They are put together since they have the same effect on the balance sheet, but this is misleading to the users. Now, currently, IS1 will require you or the preparer of the financial statements to present in current and non-current classification, unless liquidity provides more reliable and relevant presentation. Note that the liquidity of the presentation is commonly used by the financial institution. This is, let's say, the banks and companies in such a business. Yeah. Now, what should comprise a current asset? An asset should be classified as current if it is expected it is expected to be realized in or intended for sale on consumption in the entity's normal operating cycle. So what is your operating cycle here? I'm going to look at what is your gestation period for your assets. In case, let's say buildings, there are big companies that are, for a normal company, a building is a non-current, but people are dealing in real estate, you'll find that these same plots or the same buildings are looked at as inventory. So the classification there will be different. Also, it is held primarily for the purpose of being traded, as relating to the earlier example. If company A that is, let's say, a service company, if it is going to deal in, it is constructing a building for the future, not to trade, they are going to use it as their offices and whatnot. Their classification is going to be different from, let's say, Jomai, that is trading them. These are holding them for trade transparency. And also, we shall have the old concentration test, which would be, if I'm told, you are going to realize it in within 12 months. Here we are looking at mostly the problems come in the balance sheet where you're having receivables and sometimes payables, where it is a receivable in a sense. It is recoverable in a short while, but it is more than 1 year. An example would be how to treat gratuities, or let's say you have deferred income. How when you're going to recognize portions of it in the different years, how are you going to have it? Financial liabilities arising from IFRS 16, how are you going to treat them? Because there are those that are in current, are going to have to be classified as current or non-current, depending on the time that they are going to be realized by the company. Also, as earlier, as I've used the same examples across, the liabilities will have to look at when are you going to settle them. Is it in the same, a singular operating cycle? If it's more than one, then a portion of it is going to be classified as non-current and will fall due in that subsequent period. Is it did you incur it in primarily for the purpose of being in trade? Is it going to be settled within the next 12 months? Does it have an unconditional right to defer? In case it does, then it is a current liability. That will take me to my next slide. I think that was to do it for the IS1 and IS8. We have the amendments to IFRS 17, though this has been deferred to 2023 because the standard in itself is complex. It's still being studied for better usage. It looks at it's going to look at it's going to establish the principles of recognizing and measuring presentation and disclosures of insurance contracts to be issued. But I will leave this to the future, that when it is more detailed and being understood on a more wide spectrum. That will bring us to the end of the current or the new updates, but there were amendments within the year that all these are going to, if the effective dates are in January 2022, we are going, but early adoption is advised and is allowable. One, when you look at the paragraph 16D that I've detailed there, it previously stated if you're going to adopt financial IFRSs, you needed measure liabilities at either recurring amount that would be included in the parents, let's say for the subsidiary. If at all the company, it's a group of companies and the parent has already been applying IFRSs, then as subsidiaries, of course, their amounts or their balance sheet is included in the parent's balance sheet. So there are two options which are included, either the carrying amounts that would be included in the parent's consolidated books, or carrying the amounts required by the rest of the IFRSs. Those are the two options. But now, the amendment has been proposed and has been enacted to require that in case you're going to apply paragraph D16, which is carrying the amount, taking the amounts in the parents' books or consolidated books, you will have to measure the cumulative translation differences using the amounts reported by the parent. If at all the parent has been presenting PPE, which the subsidiary has not been using for, let's say, 5 years, and currently the subsidiary has chosen to incorporate IFRS in their presentation, they will have to take in charge, or they have to effect the cumulative translation differences for the different from 5 years ago to date when you're choosing to present the financial statements as what, as IFRSs. Also, there is an impact on IFRS 9 financial instruments. This has introduced a 10% derecognition test for liabilities that you're incurring. If at all an asset, if you look at the paragraph B336, which is looking at when you recognize financial liabilities, one entity. Let's say you have a financial liability for an asset, you have issued a financial asset, so you have to, you maybe repurchased it back, and there are fees in there that you've incurred by either the borrower or the person who is taking on your financial instrument. There is a recognition, a 10% test that you have to do, and this could be amounts you incur to discharge the liability by paying off the previous owner or the creditor of the any of the financial assets. Maybe there were legal constraints or legal amounts that you incurred in moving the assets, the assets from the previous owner back to you or someone who has acted as a guarantee, that you will have to test them for in case there is a 10% increase in the movement of the expenses or the increase in the liabilities. You will have to recognize them. So that will make it for the amendment. And all these you should note that they are coming into effect. The effective date is January 2022. Also, we have, when looking at paragraph 6, there's an example for IFRS 16 to do with leases. There was an illustrative example that necessitated the lessees to write off or to recognize the incentives that would be available to them. Previously, we have been you recognize the right of use. In case you've made any cash payments, you redact that in the current year. But also in case you've gotten an incentive from the lessor for maybe a reimbursement on what you incurred. Previously, you've been increasing that onto the right of use. But previously, but currently now, you're going to have to recognize that under any other IFRSs. You're not going to be adding it back to the cost of right of use. Lastly, among the amendments, it is to do with IS 41, which is looking at the cost implication you're going to incur or you're going to recognize in coming up with the cost of the assets. Or these are animals or bearing plants that have been recognized in accordance with IS 41. Currently, we have been derecognizing the taxation on it. But now, the proposed amendment would remove the requirement on this paragraph to do with the taxation. We are going to be disregarding. We are going to be recognizing that any entity does not include any cash flows for financing those assets, e.g., the taxation or re-establishing the biological assets have after the harvest. If you will not have to recognize the taxation amounts. I think that will do it for me. As for to cover for the new updates and the amendments that we have. Unless there are any questions, we shall warmly welcome them.
Thank you, Davis and Sumesh. Very well done. That was very good in terms of taking us through the changes in the IFRS standards. And thanks to our members for staying with us. Davis, I don't know that, I think if you could please mute. So we'll now go to the Q&A session. We've not received very many questions. I attribute it to everyone having been very attentive, as the sections that were being talked about were very critical and impacting all the businesses, and specifically in these challenging COVID times. But I encourage everyone to continue raising the questions, and we'll be discussing them and giving you responses as they come through. I'll now request CPA Sumesh to respond to the first question, which was raised by CPA Dr. Albert Otete. And the question is IFRS 23 uncertainty over income tax treatments was effective 1st January 2019. By rulings by the Tax Appeals Tribunal, I take that Tax Appeals Tribunal of Uganda, have gone against some companies and billions of shillings are to be paid to URA. And the question by Dr. Albert is, should the amounts to be paid to URA be accrued as an expense or disclosed as a contingent liability? CPA Sumesh, please respond to that. Thank you.
Thank you. It's a tricky one. Remember, a case that is determined at tribunal still has the ability to be taken to High Court and up to the Court of Appeal, I believe, which is the highest court in Uganda. So it is still a ruling that if the client is challenging it in High Court, you still have to wait for the outcome of that particular ruling from the High Court. And then again, URA may decide to take it to Court of Appeal. Then again, you have to take it to, you have to wait for the ruling of that particular Court of Appeal. So in my view, you will treat it as a contingent liability because you're still not sure what the outcome is, especially if the client, it is in your knowledge that the client has proceeded with this matter to the High Court, even though that they have lost at tribunal level. But if they have not and they have taken the tribunal ruling, then it sets a tax precedence, and tribunal rulings, you are bound to it. Then you would rather recognize it in your financial statements. Yeah. I hope I'm clear there, Dr. Albert.
Thanks, CPA Sumesh. If anyone needs clarification, please do raise it on the Q&A, and we'll respond to it. I think the next I'll try to go in a sequence. There is a request by a member that these slides are shared, and the audio is also shared. I do believe CPA has taken note of that, and we trust that you will share the slides. If there is an audio, I trust that you'll also consider that. I don't want to comment on that, but I know CPA will do everything they can for their members. The other question is from Maria Namuyaba. Thanks for the good presentation. How would you classify a payable that you have thought to pay within 1 year, but instead you fail to pay and pass it on to the next financial year? And in fact, you end up pushing it for 4 years. Would it be classified as a long-term liability? That's a quite interesting one, CPA Sumesh and Mr. Davis. I think it differs from the actual state of the liability. So I think the members will be keen to hear your answer to that. Please respond.
Yeah, okay, thank you. Remember, one of the tests that you are applying to your assets and liabilities is what is substance over form. So what is the actual nature of that liability? If it is not your intention to pay it within the next year or so, and if you do not have the ability to pay it, then you have to classify it as a long-term liability. Yes, so that it's a very easy question to answer.
Thank you. Members, we do hope that the answers are clear and they are addressing your questions. Should you need any clarification, please raise it. The members are still with us and they are more than happy to answer the questions. The next one is from Mr. Joseph Wambi. Kindly clarify who primary users are, who are lenders and who are creditors in connection to materiality. I guess the question is rotating around who exactly are we targeting when we put materiality considerations into play. I'll leave it to the practicing CPAs to answer that. Please give us your answer.
So if I understand the question correctly from CPA Joseph, is kindly clarify who primary users are. Yeah, so primary users, CPA Joseph, you seem to have already given us examples. They are your lenders, creditors, and first level of users when it comes to reading your financial statements. In connection to materiality means that if a misstatement or an omission or a distortion, like my colleague Lado has been telling you about with the new definition of materiality, leads to any of these guys making a decision, say a bank, if you have classified a long-term payable as a short-term payable as a long-term payable and increased your net current asset position because of that classification, then you have misinformed perhaps your bank that's going to use these financial statements to offer you a credit line. So it's material and it's wrong. I hope that answers your question.
Thanks, CPA Sumesh. I hope, Joseph, you're satisfied, but should you have a need for clarification, please raise it. Maria is asking, in real estate due to COVID-19 impact, large discounts have been given to tenants, and she's requesting for guidance on how this can be well presented. I believe this rotates around revenue recognition. CPA Sumesh, if you could please give an answer to that. CPA Sumesh, please feel free to direct any of the questions to Mr. Davis as you deem fit. I think in the interest of avoiding a clash, I'll direct all of them to you, but please feel free to pass on any.
Fine.
Yeah, please carry on.
Spencer. Remember, lease liability is about recognizing the entire quantum of the lease. You're being very specific, CPA Maria, on your question. So what it means is, if you had a 5-year lease and each year you are supposed to pay 100 shillings as rent, you would accrue for the entire 500 shillings in your balance sheet. Yes, and concurrently wind it down to recognize your finance charge and all of that on it. So what it means is that if now you have given a discount, maybe it's for a year or maybe it's going forward for a couple of years, that lease liability might not be 100 shillings. It might only be, maybe you've discounted it to 80 shillings because of COVID for the next 5 years. So then you have to adjust both your P&L in revenue recognition as well as recognizing the lease liability at 80. And then you still have to wind down that recomputed amount of 80 to come up with the net realizable value of the lease. Yeah, thank you.
Yeah, thank you, Maria. That's the response. Just for clarification, the responses are going to everyone. So anyone other than the person who raised the question should feel free to seek any clarification. There is an interesting question from Elia Tumuhimbise. Can a tea estate or plantation be depreciated? If you could please respond to that.
Yeah. So you know that with the recent change in IAS 41, you are able to classify bearer plants as under property, plant, and equipment. So if your tea plant, yes, meets most of the criteria, meets all the criteria of being classified as property, plant, and equipment. So if you have classified it as property, plant, and equipment, yes, you can depreciate it. Thank you.
Thank you, Mr. Sumesh. Just maybe for clarity of the members, I think they are probably asking themselves how a tea plantation would fall under property and equipment. Maybe if you could just throw more light around that. I guess most should be looking at it as a biological asset. Yep.
Yes, not the plantation, Spencer. Remember, we are now differentiating between bearer plants and the biological asset. Correct. So the tea plants in the estate, which is now majority of the asset, now becomes what? Part of your property, plant, and equipment. Correct.
Yeah.
Yes. So that will be depreciated. Yes. But the ones that don't qualify, that are still under biological assets, will still be treated at fair value as per the principles and guidance under IAS 41.
Thank you. I hope that that clarifies as actually looking for that distinction, just so we don't have any wondering. But thanks for that, CPS Umesh. That brings clarity. Another question from Ivan Ruvuza. Due to the impact of the pandemic, some very huge employee pay cuts have been effected contrary to staff contracts. Is this justifiable in case such decide sue with the employee, sue I imagine the employing organization? CPS Umesh, you very well know that being a practitioner, you're expected to be a jack of all trades. This is a legal question, but I trust you have an answer. So if you could please answer it.
Yes, Spencer, I'm going to take a pass on this and refer it to the lawyers, because seriously, this is more of like to deal with the law of torts and contracts and things like that. So it's a legal answer that needs to be discussed at judicial or legal level. Really not something that we can comment on over
here. Thank you. I think that's clear for the members. It has some legal implications, and ideally it will also vary on the circumstances under which the terminations or staff reductions are being done. It is a bit complicated, given that one, it's a difficult time for the employees, for the organizations. Probably one thing to remember is that employee contracts usually have termination clauses, specifically in times like this. So for as long as the business can justify, then it becomes a case for the courts to decide. I think there is no right answer to that. It really goes down to what the terms are. The next question is, how can an entity rectify an inappropriate in accounting policy? Okay, I'm not, I would need, let me try and see if I can rephrase. How can an entity rectify an inappropriate in accounting policy? If Ruth, you could help with that, or if Mr. Sumesh can figure it out, maybe you could give it a go ahead.
Okay. There are guidelines in IS 8 that will guide you on how to rectify estimates and errors. Now, an inappropriate policy, let's say I'm taking an example of let's say depreciation. In case it's an error, you will have to correct it retrospectively, as referred to the earlier person. In case it is a policy, you're going to correct it prospectively. Things like, let's say you were valuing inventory wrongly, and now you're having a better presentation, not out of error, but just as a change of company policy. It's going to be prospective. Had it been an error in the prior periods, you would have to look at it in a retrospective manner. So this is a change in accounting policy or errors.
Thank you, Mr. Davis. There is an interesting question here from Maria Namiaba. Is it possible for a company collecting rent and has the responsibility of fully accounting for funds collected to recognize buildings if the buildings are not in the name of that company? Effectively, if you're collecting rent on a property and you're responsible for everything to do with that collection, but it's not in your name, can you recognize that building in your books? If you could please respond to that, CPA Sumesh or Mr. Davis.
Yeah, thanks, Spencer. Okay, that's an easy one. If you're responsible for collecting the rent, you're basically an agent. So the assets are not yours. The assets are somebody else's. So you're making a commission for collecting the rent, I assume. So you can't recognize those buildings in your books. Yeah, the buildings belong to the person who owns them and who has appointed you to collect the rent.
Thank you. Thank you, CPA Sumesh. And probably to Maria, I think it depends on the buildings not in your names but owned by you. I think that there is also in who legally owns the buildings. That would, but now I think your question was very direct, and Mr. Sumesh has given a direct answer. But there may be probably a few assumptions that CPA Sumesh has taken. If the buildings are probably owned by the entity, but simply not in the entity's names or by another related entity, I think different considerations can be made. But thanks for the answer, CPA Sumesh. I'm just trying to work around what Maria was working towards. Thank you, everyone. We've answered all the questions on the Q&A. We still have probably another, we'll give it another 5 minutes in case there are other questions that are going to come through before we come to the end of the session. We do appreciate everyone for listening in. We do appreciate our facilitators for a very insightful presentation that they've shared with us today. So in the next 5 minutes, we'll probably attend to any other questions. We'll also leave them for the panelists to mention anything else that they may want to add or anything that they've observed during this webinar. Thank you very much for keeping with us, and we'll be closing shortly. I request CPA in the meantime, ICPAU, to mention, to talk about the request to share the audios so that the members can know whether that's a possibility and they do not have to wait for it specifically.
Yeah, thank you so much, Chair, and thank you, Sumesh and Davis, for a wonderful presentation. We will share the slides through your emails, which you registered with us for this webinar. And the videos, you can also access the videos on our YouTube channel. There are a few things I would like the participants to take note of. Number one, we have a webinar on Friday, practitioners webinar. We invite all of you to be part of that webinar. It's good, it will tell us the updates, the emerging trends and practices in our accountancy practice. Then we have a cyber security and IT risks webinar next week on 29th. Please note those dates so that you are able to attend. Very importantly, we have an AGM. The Institute's annual general meeting will be there on Thursday, 30th of July. I believe you have received the links to the webinar and the related information. As you today we've talked about IFRS updates, and they have shared with us the developments in the IFRS arena. I want also to invite you participants to participate in the financial reporting awards. I know where you are working. Last year you completed your financial statements, and possibly this year they were audited. Kindly submit your annual report, your financial statements for last year, any period within 2019, and you'll get a report on what you should have done, or if you did best, then you are awarded at the financial reporting awards ceremony. I believe, Spencer, you've been participating. Then you need to write an email to firewords@icpau.co.ug for any clarification. But it is simple. Simply submit your financial statements. You can submit them in soft copy, or you can do so in hard copy. Whichever is easier for you can work for that regard. Chair, I think that's what we can communicate as per now. I thank you.
Thank you, ICPAU. There was a question to you as well. It was, will the current amendments to IFRS be examined in the current year?
Oh, fine. That one I may not have a position to comment on it now, but let the person write an email. But what I know we have, while the examining system takes on that role, they do, even in the syllabus, it indicates you are supposed to know what is required in the syllabus and the emerging issues. An accountant is supposed to be that's why we move into all these webinars, to be more futuristic and so many things. And as we train accountants, we also put that aspect in their minds. So if current standards or revised standards are put in the syllabus, then it is assumed that you have been exposed. Then you know what is current. Yeah, thank you.
Thank you. There are two questions that have come in. The first one is quite interesting, and I think everyone will be eager to hear what CPA Sumesh will respond. Kajubi wants to know that the current IFRS will remain relevant after COVID. Mr. Sumesh, if you could give us your take or your guess.
Sumesh has stepped away. I will take that. This is Davis, yeah? Now,
Davis.
The post-COVID IFRS amendments are in relation to the transactions that have been in the COVID, in this COVID era, yeah? So COVID is here to stay. We're going to have these IFRS's operations that are going to be carried on, because I don't think we thought it was going to be here for 1 or 2 months, but as until now or until forever, it's going to be here. So we cannot rule it out that we cannot regard them null and void at the end of the year, because we don't know when COVID is going to go away. But the effect of COVID is going to stick with us. In my opinion, they are going to stay.
Thank you. Mr. Davis, we have our final question. It is quite long, so I'll just read through it. For a lease where the asset is in the names of the bank, the company has paid 10% of the cost. So let me take that PKF East Africa is buying an asset, maybe a vehicle for the senior associate, Mr. Davis. You've paid 10% of the cost of that vehicle. And the question, so I'm trying to break down the question. The question is, do you recognize that asset in the company books, or you wait until all money is paid. And I think this is centering around lease financing. The question goes on to say, for the money paid by the bank directly to the supplier, what accounts would be affected? The supplier sends the invoice to the bank, and the company does not copy. What I take is, I read that to mean the company does not probably get a copy of that invoice. Is the bank supposed to send a copy of the pay advice? If I may just rephrase it maybe for ease, a company is buying an asset, it pays 10% of the asset, the bank pays the balance, and probably the asset is in the names of the bank. I think I'll leave it to you, Mr. Davis, to structure it around leasing and give an answer to the members.
The standard is gives guidance on how to recognize such transactions. There is something that we should understand, that there is a lease here, and there is also an agreement on payment. Yeah. So in the standard, it will detail that let's say a company got a facility to finance purchasing maybe buses. Let's say Pioneer has gotten that facility. You ask yourself, what will the bank, or let's say Bank of Africa, what will it do with these buses? Ideally, there is substance of a form that you have to recognize. You have to put into consideration when you are recognizing the transaction. The lease is with the specific company that is going to trade in the use of the assets. The bank just paid, just came in to help the company fund, and their engagement or their business is different from what the intended use of the assets is. I don't know that answers the company will have to recognize the assets or the lease in their own books. The bank, on the other side, is just going to recognize the receivable, and they will begin discounting it month by month, depending on the arrangement. The bottom line is the company is going to recognize the assets. The specific company that has gotten the facility has the right, has the lease in their names. The assets are theirs, but they have also to recognize a finance loan or whatever it is of liability to the bank.
Yes, Chair. I request the audience to send more related questions regarding like what Davis was attempting to answer to standards at icpau.co.ug. We should be able to answer most of those questions. Network. Are you on this thing? It has gone.
Ambrose, so
Yes,
warm thank you for having us on, and regard to all the participants, please stay safe. I think as PKF, we are signing off now. Good evening.
Yes, thank you so much. Yes, cheers.
Sorry, CPA, we request you to close the meeting. I think we've come to the end.